Gold prices are currently trading near record highs. For many investors, gold feels safer than ever. Some believe gold can only move higher from here. That belief often appears near market peaks. Financial markets rarely move in straight lines. They move based on expectations, data, and policy shifts. When expectations change, prices adjust quickly. Gold is no exception to this rule. In recent months, gold has benefited from strong tailwinds. Real interest rates have remained sensitive. Investors continue to seek protection from uncertainty. Geopolitical risks remain part of the global landscape. These factors have supported gold prices. However, strong support does not eliminate risk. In fact, it can sometimes increase it. High confidence often leads to crowded positioning. Crowded trades tend to be unstable. This video focuses on the risks behind the gold rally. It is not a call to sell gold. It is a discussion about timing and risk management. Understanding risk is essential at elevated price levels. The first major risk comes from Federal Reserve policy. Markets are currently pricing in future rate cuts. But those expectations are not guaranteed. If the Fed delays easing, sentiment may shift quickly. A more hawkish Fed would push Treasury yields higher. Higher yields increase the opportunity cost of holding gold. Gold does not provide income or yield. Yield-producing assets become more attractive in comparison. A stronger U.S. dollar could follow. Dollar strength has historically pressured gold prices. Currency movements play a critical role in gold markets. Many investors underestimate this relationship. The second major risk is disinflation. Gold has long been viewed as an inflation hedge. Inflation concerns have supported gold demand. Expectations matter as much as actual inflation data. If inflation continues to cool, those expectations may change. CPI and PCE data are closely watched by markets. Softer readings can reduce demand for inflation protection. Gold may lose part of its defensive appeal. This does not mean inflation risk disappears entirely. It means markets adjust their outlook. Asset prices respond to changes in expectations. Gold prices reflect those changes. The third risk involves geopolitical developments. Gold benefits from fear and uncertainty. Rising global tensions often drive safe haven flows. That dynamic has supported gold historically. However, geopolitical risk can ease unexpectedly. Diplomatic progress can shift market sentiment. Lower perceived risk reduces demand for safe havens. Capital may rotate toward growth assets. Equities often benefit when risk appetite improves. Gold can underperform in those environments. Asset allocation decisions are always changing. No trend lasts forever. The fourth risk is investor behavior. Gold has attracted heavy inflows in a short period. Momentum-driven buying has increased. This creates fear of missing out, or FOMO. FOMO leads to emotional decision-making. Emotional markets are more fragile. Small negative news can trigger profit-taking. Selling can accelerate quickly in crowded trades. Liquidity can disappear during sharp moves. Price corrections can become sudden and deep. Late buyers often suffer the most. Risk increases near market extremes. The worst-case scenario involves multiple risks aligning. A hawkish Fed combined with falling inflation would be significant. A stronger dollar would add further pressure. Together, these factors could challenge the gold rally. Technical support levels could break. Short-term corrections could intensify. Volatility would likely increase. Investor confidence would be tested. This does not mean gold has no long-term value. Gold remains an important diversification tool. The issue is entry timing and position sizing. Risk management matters more than predictions. Chasing price momentum increases downside exposure. All-in strategies amplify losses. Diversification helps manage uncertainty. Every position should have a downside plan. Investors should ask critical questions. What happens if gold falls 10%? What happens if it falls 20%? Preparation reduces emotional reactions. Markets will always be uncertain. Risk cannot be eliminated. It can only be managed. Discipline separates successful investors from the rest. This video is for educational purposes only. It reflects personal analysis, not investment advice. Every investor's situation is different. Always do your own research. Understand your risk tolerance. Stay focused on long-term strategy. And what's your take on the gold market? Feel free to share your thoughts in the comments below. Thank you for watching, and see you in the next video.